You made news today when the president decided to quote you in his tweet. He says that if the Fed backs off and starts talking a little more dovish, I think we're going to be right back to our 2,800 to 2,900 target range that we've had for the S&P 500. That's what you wrote, and the president quoted and said everybody should listen to you. How did that feel?
Well, David, I can't really comment specifically on that tweet, but let me say that, for us, the two biggest risks that we've been pointing out to our clients for over a year is the Fed making a mistake and global growth slowing down. So, for us, the Federal Reserve is key here going out over the next year. The target that you quoted, the 2,900, was our year-end target, has been our year-end target. But what we're trying to do is really focus clients a little further than that out. And what our equity group is looking for is maybe 15–17% return from these levels over the course of the next 12 months. So we want our clients invested. So
you may well be right, Scott. You know more about it than I do in terms of what would happen with the markets. But the Fed says, look, we've got two jobs, and that is to control inflation and also to keep the unemployment rate low. The unemployment rate is really, really low, and inflation is just right at that 2% level, even with all the hikes they've made. So from their point of view, shouldn't they just stick to those two issues?
Well, David, I think that they're certainly watching that issue. And, this Friday when we see this employment report, we may see that average hourly earnings number north on a year-over-year change north of 3%. Now, 12 months ago, if we would have seen a print like that, I think the market would have really panicked on that. I think the market's prepped for that, thinks there's going to be higher wages. But certainly the Fed, if they would react either to this potential for slowing growth or to anything else really going on here in the States or the market volatility, I think, any hint that they might be a little more dovish or at least less hawkish, I think the market would react positively to that.
So, Scott, as you know so well, we've had a tumultuous couple of weeks here in the equity markets. It's really been something here in the United States. But a lot of that seems to have come off of some of the earnings calls in which people, it's not so much they're missing on the past quarter as looking forward, they have concerns. But you don't hear about interest rates too much. What you hear about is things like tariffs and input costs, things like that.
I think when you're late in the cycle, like we are now in the later third of the cycle, the market really pays attention to things like the Fed, like we just talked about, but also anything that may pressure margins. And let's face it, these corporate margins are really high. So things like wage gains, input gains. Certainly, you've heard companies on these conference calls talk a lot about tariffs, how that's increased input costs, and how that might be doing some damage to their margins. That's not what the market wants to hear, and so that's certainly fueled or been at least a meaningful part of this pullback that we've seen so quickly.
And finally, Scott, would the problem be alleviated some if other central banks started to move in the same direction the United States was? Because how much the problem is a stronger dollar, because we're hiking and the ECB hasn't gotten started yet and Bank of Japan doesn't seem to be interested.
Well, they're earlier in their cycles internationally in general, and I think you'll probably see them. I think tighten might be a strong word for 2019, but I think you'll start to see many of these other central banks back away from these easy money policies that we've seen for the last 10 years. That could help things, but really, David, once again, I think it goes back to what are earnings going to be next year? They certainly aren't going to grow anywhere near as fast as they did this year. What is the Fed going to do? And what about global growth? I think those are the issues that the market is going to be focused on over the course of the next 12 months. We're looking for a continuation of positive news. We don't think this expansion is over, and we're certainly looking for a good gain in the S&P 500 over the next 12 months or so.